All right. I want to talk to you today about refinancing. Specifically, should you refinance now or should you wait? A consumer asked the other day that question, and I feel like I need to share that answer. So my take on this is very simple. Refinancing plays a large role in structuring your finances, whether it's your business finances on investment property or whether it's your family with your primary residence. And typically, people refinance for a lower rate, or they want to use some of the equity in their home to restructure some of their other finances. And there might be for a few reasons for that. They might use some of the equity to pay off a car. They might be borrowing at a higher interest rate on their vehicle, and now they can borrow at a 6.25% on their home, take some of that money and pay off their car. A second way is they might want to use some of that capital so that they can pay for perhaps a child to go away to private school or to college, and they're going to use that money to pay some of that tuition. And another reason would be a consumer might use some of that equity to pay off some other debts, such as some revolving credit card debts. And in each of those cases, we're increasing the amount of money that we owe on the home as compared to the value of the home. So hopefully the value is going up at the same time, the same level as the debt is going up. So my answer is very simple. I would recommend you refinance if, number one, you are comfortable with making that payment mentally. And I said this in another video the other day. A lot of it has to do with, are you able to make that payment without it causing a lot of stress, financial stress, or at-home stress for you and your family? It's one thing to get rid of the debt, but if you get rid of the debt and all you do is shift it from this bucket over to this bucket, and suddenly you have a really high house payment that you're unable to make, you're just causing yourself more harm. So take a look at what is the cost of refinancing, what are the closing costs, and how much is the debt increasing. And then the third factor is, what is your savings? And as long as you are going to pay your closing costs back within 36 months, it is an acceptable loan. I don't believe 36 is, I think that is too long, but 36 is an industry number that is acceptable. I believe you should be able to work with your lender, whoever's making that loan. And if LendingMan's making you that loan, we are going to do no cost refinances, where we might only lower the interest rate by a little bit, but we're going to give you premium that we're going to earn when we sell that loan to the insurance company. We're going to give you premium, and we're going to use that to pay all of your closing costs. By doing that, your amount financed goes up, but your closing cost portion of that amount financed is very low. So on, let's say, for example, a $1 million loan, if you can keep your closing costs at only $5,000, then the lender is giving you a credit of 50 basis points, which is very nominal, and that's very acceptable to do. You might raise your loan amount by $100,000, and out of that $100,000, you're actually getting $95,000 of that money. And APR is basically the formula, which is calculating in the cost of financing in addition to the interest rate. And I always explain it like this. If you borrow $100,000 and your closing costs are $5,000, if your mortgage payment on $100,000 is $1,200 and your mortgage payment on $95,000 is $1,200, they're equal payments. Whatever that number is, that's the annual percentage rate. So your interest rate is lower, your interest percentage rate is higher, and that larger that spread of loan amount versus the loan amount minus the closing cost, the larger that spread makes the APR go higher. The higher the APR, the longer it takes for you to pay it back. The end result is you don't want to be making a payment on that loan for more than 24 to 36 months. That's really getting up there to pay back the closing costs. That's the cost of doing the financing. So negotiate with your lender. negotiate with the bank, negotiate with your loan officer, negotiate, speak to your lending man to try to get more credits to pay for those closing costs. That's what we're here for. That's what I do. So, as far as interest rates are concerned, it doesn't really matter whether interest rates are higher or lower if your objective is to consolidate debt or use equity to pay off other large credit cards or use equity to pay for some investment, whether it's another property or college. Of course, it's time to refinance. That property is the basis of that loan. And the American financial system is built on credit. If we are not borrowing, we are not creating wealth. Now, some would disagree with me, but the American financial system is built on credit. You are not going to save your way to prosperity. I'm not saying don't save money. What I'm saying is you're not going to save millions of dollars. You're going to have other investments. And in order to do that, you have to have income and you have to generate some other capital. And the easiest way to do that through real estate is by leveraging and using the real estate asset to generate the capital, which generates the wealth. And there are other systems that we can put together where you are borrowing on those properties through either refinances of the subject property, which might be your home or another investment property, to multiply the numbers of real estate that you have. The more real estate you have, the more you can borrow. The more you can borrow, the more money you have. The more money you have, the more you can borrow. It is very cyclical. So I hope that helps you. All right? So who's your lending man? Yeah.